Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. G'day everyone, and welcome again to our next conversation on Profitable Farmer. Wonderful to have you. We've had about 5 inches of rain over the last 24 hours, and it means that I'm sitting here marooned. We can't get out to shops or schools. So I've got 4 kids here, and I'm looking out the window. They're towing each other behind the motorbike on surfboards across wet paddocks. It's a work and health and safety issue, but gosh, it brings back some fond memories of kids of just growing up on the farm and doing stuff like that. It's just wonderful to see the enjoyment and the freedom that the kids are exploring, not able to get to school today. So what I'm saying is if there's any noise in the background, I apologise in advance. They're probably likely to come in for lunch at some stage, and they may well interrupt this podcast. But thought I'd just share that. I hope you're all well wherever you are. Hey, every 6 months or so, it gives me great pleasure to invite Tran to join us on Profitable Farmer and update us on everything that's playing out in the broader global economy, the impact it's having on various markets, on equities, and on our realities. A lot's happened over the last 6 months, and so absolutely perfect timing, I feel, to have Terry join us. To those of you that know, Terry won't need introduction, but at Farm Owners Academy, we endorse and support Terry's efforts to educate farmers and others on wealth creation, on share market investing, on helping people learn the skills to successfully grow wealth outside their farm. So Terry, welcome. Great to have you with us again.
Thanks, Jeremy. Always a pleasure to be here.
Terry, I'm going to kick off just left field, if I could.
Sure.
How many clients do you now have, and how many countries are they in?
We've got just, we should have over about 1,200 plus. About 230 of them are Aussie farmers as well. So I'd probably say in terms of, country-wise, funny enough, a lot of it grew organically because we've also got quite a few, airline pilots inside our program. And a lot of the international students that we have actually came from the airline pilots simply by spreading the message while they were there, either with their friends or family, or even at hotels, for example. So I'd probably say close to about 10 different countries, especially in Europe, the United States. Singapore, we've got a big contingent there. A lot of financial planners and accountants are from Singapore, and just all different parts of the world.
Quite incredible. Your business growth in and of itself is quite an amazing story, Terry. Did you ever predict that it would be as you just described?
No, nowhere near it. My very first thing was all about just writing a blog. 7.5 years ago, just to save people from getting scammed and getting into the wrong thing and getting taught the wrong thing. So that initially just started as a blog, and I actually had no program, no course. And interesting enough, after writing for about 3 or 4 months, one of the major publications in the United States actually contacted me by email and said that I actually write well, and in terms of languaging, very easy, simple and easy to understand. And they asked me to contribute to their 80,000 members, literally. So a lot of our initial students also came from the United States in the West Coast, California and Los Angeles. Definitely had no idea that it would become this. The only reason why I actually have a program is because those initial people who read my blog actually asked me, do I have a program? And I kept on saying no for a number of months. And then finally I had to put together something just to start teaching that side. And funny enough, my initial test students were actually my friends that felt sorry for me.
There's no doubt. And I think what our farmers really value about what you do is that it's just so practical. It's so pragmatic. You teach it so cleanly and so clearly without the jargon. And it just means that people can learn and apply what you teach to their realities and get real results. Terry, why is it that you do what you do?
I actually just want to give someone a life skill because I've been managing funds for a long time. And of course, I've noticed that, people they know what I do. They understand what I do on a broad scale. They see the returns. But ultimately, in the end, I'm only helping a small group of people that can afford to invest with me back in the old days. And then I realized, to make a bigger impact is actually physically teach exactly what I do on a broader scale. And people who understand that, it's not about taking extreme high risk to get the return you want. It's all about, in fact, the total opposite, about managing risk and minimizing it to as little as possible, and just have that consistency year on, year out. And while they'll build their portfolio, they can also sleep as well. So just giving them that life skill, I call it the life skill, they can then pass on to the next generation. So create that intergenerational education as well as wealth. And it is clearly working because a lot of my youngest student is in fact 9. So she's a daughter of one of our students, and my other youngest is 12. So we've got quite a few teenagers in our program already as well.
How good's that? That's amazing. So there's a distinction there. A lot of us have financial planners, and a lot of us have stockbrokers, that do it for us.
Yes.
You teach people how to do it for themselves. Why have you chosen to teach rather than tell or do in this space?
I think I've done it for people for a long time, and obviously I give them returns, but then I can never really see a big change in terms of, obviously on a broader scale of other people, and just hearing all the sorry stories, from people who have been scammed, lost a lot of money, etc. And I realized that it's actually far more important to, even if someone's got a financial planner or a broker, it's actually really important that you at least know what they are actually doing, with your money, and not just giving them full control. Because as I've also got a lot of financial planners in our own program as well, and a lot of them, funny enough, they came because their clients ended up knowing more than them. So they actually seek me out to see where are their clients learning from. So they've actually joined my program so they can at least be on the same level, which is actually quite interesting. So I think it's really important, whether you've got advice from somebody, that at least you know what they are actually doing with your money, because I always have that saying that, no one will ever care more about your money than yourself.
I can sign up to a gym and pay the gym membership and not get fit, Terry. But for those people that are signing up to you and really leaning into the process and applying the education that you share with them, results do you see some of your superstars or the top 30% of your members getting?
Oh, they're easily getting double-digit returns on an annual basis. And in some cases, 3 or 4 years, they've actually already doubled their money. And they actually openly share that in our Facebook community as well. So it's all about just that consistency. And in the meantime as well, while they're getting that, they totally understand. One, they understand what they're doing. And two, they, like I said, while they're creating it, they actually can sleep well at night, because they're literally building a what I call a super portfolio that just owns top world-class companies that pass our criteria, our very stringent and strict criteria, but also they are literally companies which a lot of us, funny enough, we already use their products, goods and services, but we don't, funny enough, invest in them. And yet a lot of these companies are all the big names. So it's very also comforting that when you own a stake in that company and you already also use their products and you've used them for years, it's also a very comforting factor to hold on to those companies, because you know that these companies are part of our daily lives and they just won't go anywhere. They're here to stay.
One thing that we pride ourselves on at Farm Owners Academy is teaching people how to be self-reliant, so that they don't have that dependency on their consultant, their agronomist, their accountant, or anyone. There's a distinction there, isn't there? Getting double-digit numbers year on year, and doing that for yourself versus getting double-digit numbers year on year, someone else doing that for you.
Yeah, correct. Because firstly, the control's there, but two, you've got the skill. So whether they're there or not, going forward, it will never matter, because you've got that skill for life. And this is really going to be a life skill that you'll use for the rest of your life, and obviously pass on to the next generation, which is even more important, because I know a lot of people, they had the skill, let's say, for themselves, but how good it would be to also be able to pass that on as well, because I think that's one of the greatest gifts that any parent, for example, can give their children.
Absolutely. I think so many of us can be at risk of abdicating responsibility in this space. You know, we handed our portfolios over to a financial planner or a stockbroker, or we put it in a super fund or whatever, and we abdicate responsibility. I think we've got to be really careful of doing that. What I love about the partnership that we have and what you do for our members and for those 1,200 clients of yours is that you teach them to be self-reliant, and they can absolutely be in control of their wealth creation and have a risk-aware certainty, if you like, that they can continue to get results irrespective of what the market's doing.
Yeah, correct. And I even say that, you know, the skill I even want to give them is to be, once they're taught the lesson, they physically also don't have to rely on even me as well, even though I've taught them the skill to not be reliant on Terry Tran himself as well. And then that's a real gift that I can give people.
Absolutely. So Terry, let's turn our attention to just what's played out over the last 6 months since we last caught up. It is a fascinating time in history, really, isn't it? You know, last time we talked about COVID and certainly Ukraine. Now we talk about China-America relationships and the tension there potentially increasing. And there's new dynamics both for us locally and globally in what's playing out. What's your read on what's happened in the market and economically over the last 6 months?
Yeah, I mean, a lot has happened. I mean, when we spoke last time, we're just starting to have that mild sort of pullback from the markets. And I actually saw that as a healthy thing because, I mean, we've been talking, even at that point when we had the last session together, the market was already quite overvalued. So I always say that things will only get to a certain stage where the euphoria will slowly wear off. And then all it takes is a bit of a catalyst. And that time, 6 months ago, the catalyst was that Russia-Ukraine. Since then. But of course, a lot more has happened since then as well. And the market has pulled back, depending on which index you're looking at, all the way from between 25 to almost 30, basically a third, 33% down in a lot of markets. Now, they've since recovered slightly, but a lot of questions, you know, I get asked is, you know, is with all the things that's happening right now, you know, is this the actual bottom of the market or, you know, can things get worse? And it's definitely not the bottom of the market from where I see things. There's going to be a lot more volatility. That's going to happen. And there's quite a number of reasons. I mean, one of them is, for example, what you just spoke about, you know, with the Chinese and American relationships with Nancy Pelosi going over to Taiwan to actually have a bit of a visit. And now China retaliating and saying that, you know, dire consequences will happen. But I just see that as just simple, big headlines that make the news. But people have to understand it's a very different scenario compared to what we had with Russia-Ukraine. Because Russia-Ukraine, first of all, with Russia, they had, in a way, I think, a behind-the-scenes blessing from China. And a lot of their business was not, you know, reliant on, say, the United States to buy their products, etc. And therefore, and they actually had another buy in place, which was China, still buying their goods, for example, to continue funding their war, for example. So they've got that. Whereas with America and China, it's very different because I always call them pretty much being in bed together because they ultimately need each other. So as we are probably aware, a lot of the American companies go over to open their factories in China because of cheaper labor costs. And even Tesla, for example, has their big gigafactory in Shanghai building, electric vehicles there. And that's their future, literally. For both sales, but also production. The Apple iPhone went over to China, Foxconn, producing all the iPhones. And slowly I think I understand now, a lot of the American companies are slowly weaving themselves from China and going elsewhere to other parts of Asia. Like, for example, Samsung is now no longer just producing in China. I've got a Samsung phone. They're now producing in my home country, Vietnam. So a lot of them are going to elsewhere because production costs are definitely much more higher compared to what they used to be. So a lot of American companies do still rely on China, no matter what. It'll be a number of years before they can slowly weave off a bunch of their production over across to the other parts of the world because they just don't have that capacity. Firstly, for funding, but also not the cost. The cost they can get cheaper, but in terms of capacity, because China's just got this massive population, right? So that's that. But then on China's side, half of their their produce is sold to the Americans. So can you imagine with Russia what's happened? And they've been watching this as a lesson, where Russia obviously did their Ukraine thing and literally got shut off from around the world. America took their first step, and Europe, the whole rest of all the other countries followed suit. And that would probably happen with that Taiwan debacle that's happening right now as well. And they've been watching this, so they know what can happen if the world actually shuts off. And Russia's just been totally shut off from not only from produce, but also from the financial market system. So China slightly has an edge up on the financial markets because they do have their internal systems that can get around that a little bit. But ultimately, in the end, they're still part of the whole banking economic system. So they're a major part of it, in fact. So they will never risk half of their business being shut off with one country, let alone Europe. And that's not even including Europe and the rest of the world as well. So it's all about, ultimately, in the end, it's all about economic and also about money as well. So despite their rhetoric about, saying what they're saying over the media, I think they will probably do some form of warning, but it will never be the stage of doing what they've, going and that full invasion thing, which is making the headlines right now. Will they or won't they? I just can't physically see it happening. I think my grandfather was born in China, so a descendant being Chinese. Ultimately, in the end, it's all about face. So they just want to make sure they save face. So, but by saving face, they also ensure that they don't want that economic issue as well. But they're trying to find a way to save face, but at the same time, continually balance their relationship with the United States. They will need to, because that's their major trading partner, and there's no getting around that. And one forgets too that China's got one of the biggest foreign reserves, and the currency they're holding is a US dollar. So literally, they're the biggest, I guess, creditor to Americans, the American government, which borrows money, funnily enough, from China as well.
I wanted to mention that level of gross indebtedness between the two countries as well.
Yes.
Speaks to what you say. So tensions with Taiwan and things like that might see tensions escalate, but what you're saying is you don't feel like they will escalate to the extreme for all of those economic and social reasons that you've described.
Correct. Yeah, they will never get to that. They always threaten about a possible invasion, but they've already seen what happens when Russia did that, and that's just and they've learned lessons from that. So they're quite aware of that as well. And America, even though they've got this neutrality of not saying that they're definitely going to protect Taiwan, but with Nancy Pelosi's visit to Taiwan, she's made it quite clear that sending a clear message that, if something was to happen, I'm pretty sure the Americans will actually ensure that Taiwan is quite safe, because they actually need that production, that country to still be within their power as well. Yeah.
So then coming back, Terry, you mentioned that you don't feel like we're at the bottom.
Correct.
What else do you see having played out over the 6 months, and what's your read on our current reality?
I think why I say that it's not the bottom is because ultimately, in the end, we've all heard about all this inflationary thing that's been going on. And funny enough, it's only all over the media in the last 3 months. But we've been talking about this since the late last year, about interest rates being way too low for way too long. And there was, I call it, no home for money. So money always needs to find a place. And if you were to put in, say, a term deposit, you basically get nothing out of it, putting in a bank. And we've seen these very low interest rates. But now with all this inflationary happening, the catalyst, of course, was the Russia-Ukraine, and that's even made it worse as well with supply chain issues. And all this rampant inflation is now being controlled with interest rates as well. And interest rates, we've seen a number of increases from the Fed, and they're expecting in a month's time, the Fed's going to do another one of probably another 0.75 at least. And what happens is generally other parts of the world, I mean, Bank of England has just done theirs, literally in the last 48 hours. And our Australian RBA always follows suit as well. So they'll always generally being a bit behind the curve, wait to see what America does, and they'll follow suit, usually a couple of months down the track.
It's interesting. I'm reflecting back on a podcast I did with Tony Catt a couple of months ago, and he felt like in this instance, we might not follow the US interest rate rise trajectory as closely as perhaps we have.
Right.
His comment was that they might do 7, we might do 3. He doesn't think necessarily that we'll do 7. What's your view? Do you think we will follow the American interest rate trajectory, or do you think we might run our own race?
We have not really ever run our own race, because the reason being is also the foreign currency rates as well. So you can imagine what happens is whenever interest rates rise, money follows. So which has already happened, as we can see, once the US starts increasing the rates far further than the rest of the world, all the money flows back into the United States for investments. And of course, demand for those investments requires US dollars. And hence why the US dollar of late has increased quite dramatically as well over the past couple of months. And Australia can never afford to have their currency way too out of whack from the United States. So interest rates is almost like the balancing thing as well. So I think whether they, when they do 7, will we do 7? Probably not. But however, it's not about the number of interest rates. It's ultimately in terms of the level of, let's say they go to 5, what do we go to? We are not going to be at, for example, at 2. It's just too big of a difference. They need to still keep it, whether we do 3 or 4, but ultimately in the end, it still needs to have that balance and be very close to the rates that the Americans are doing as well.
So that read on our reality, what opportunities present?
I think it's going to be it's a really good period to, be patient enough to wait for quality assets. And we are seeing a lot of quality assets over the past 3-4 months now being sold off for cheap. And we've been slowly, especially for longer term passive investing, a lot of these companies we need, from Apple to Amazon to Johnson & Johnson, a lot of these companies have fallen 20, 30, 40%, and they're not going anywhere. So these are companies that we are very aware of because we use their products, but yet they've been sold off. And I think with this correction and this volatility, which a lot of people, they fear it because of all the media hype and attention. But ultimately, what I see this period as is, if you can look past that and be patient enough with the capital, is that when that actually opportunity comes, to actually use this period to set up the foundation for the next run as well. Because assets will get to a certain level, they become cheap. Value investors like myself and our students, we're aware of what value actually is, and we'll come in and buy it buy up these cheap assets and then reap the rewards down the track.
So Terry, just for those that might not have listened to our prior podcasts,
yes,
what is that value-based method or strategy, or what is it that is your underpinning investment philosophy?
Right. So value investing ultimately is, in the end, is just making sure that you don't overpay for any asset. So for example, let's say if we know a farm is worth, based on next door neighbor, etc., and what they've been selling for has been sold for $1 million and it's worth $1 million. And then all of a sudden from euphoria, all of a sudden now someone's offering, $2 million for that farm. Ultimately, in the end, the tide lifts up all boats, and therefore other farms around will probably slowly lift up as well. But the question is that farm actually worth $2 million just based on someone willing to offer $2 million? Maybe not, because obviously it depends still on the yield factor, how much does it produce, etc. So there is no difference from that to real estate, like homes, property, and also no different to stocks. It's just that a lot of people just don't know how to value a stock. So every asset has a value, what they call intrinsic value. And once it gets to that value, we as investors, longer term investors, especially if you're more passive, to get excited about that, because you're finally buying an income stream for life that will pay you that 5 to 10% dividend yield while you wait for that capital growth. So that's actually amazing, because those companies are going to be around for a long time to come. And a lot of the companies now are in that sort of paying that 4 to 6 to even 10% dividend rate, which normally in normal markets, we don't see that. But because they've dropped so much already, we are now seeing that. And that's what I call the cheap factor.
And you look globally at the best stocks globally, not necessarily just in Australia. That's correct?
Definitely, because if you can imagine Australia, we've got a population of 26, 27 million people, and only a handful, I literally can count it in one hand, a handful of Australian companies that have gone global. A lot of them have tried, like the NAB. They've gone over to the UK, they failed, lost a few $1 billion and come back. Then you've got Telstra, who went over to Asia, tried that, lost a few $1 billion, come back. ANZ's done the same thing. They went over to Asia and their strategy failed. They came back. So a lot of our companies are, in fact, quite local. So they sound big. Telstra, our big major four banks, for example. So they've got a monopoly almost of our economy. But however, they're just local and they're only serving 26, 27 million people. So why would we stay in our country when there's just so many other opportunities outside? And if we want growth, especially long-term capital growth, we do need to go external, because Johnson & Johnson, Microsoft, Intel, GlaxoSmith, what else? Facebook, all these companies are in fact all global. So why would we stay here when all the opportunities are actually in fact there, and they've got a population of 67 billion people to actually service. So they will keep on growing year after year, whereas with a lot of our companies, we just can't, simply because of we're relying on migration ultimately in the end.
So I think a lot of people sort of invest locally to try and avoid exchange rate risk.
Yeah.
What would your comment be to them?
For me, there's an exchange risk if you all of a sudden, let's say you try to pick the right time and you literally convert all your currency to, say, the US dollars, let's say $100,000, for example, and then that's that risk that you have there because you've tried to pick the right time to convert that whole lump sum. But opportunities don't come all in one go. They spread themselves over time. So we try to pick the low-hanging fruit, and low-hanging fruit doesn't just necessarily come, as we ask for them. So usually it will take, weeks, months, sometimes even years to actually utilize the capital you've got. So as you spread out your investments, you're only changing the currency every time you buy the investment. So you're actually spreading out your risk anyway. So the exchange currency, one day you might win some, other days you'll lose some. But overall, it just balances itself out. So I've actually never thought about exchange risk, unless, of course, if you're planning to retire, and then you all of a sudden need to, let's say you're invested in America, you all of a sudden need to now pull out the entire amount in one go. Then that's very different, because then there's an exchange risk there. But I'm pretty sure most people don't just retire and take that whole lump sum in one go. They'll spread it out anyway. So that exchange risk is, to me, it's more of a myth than anything else.
What else are you seeing, Terry, in the market right now? And what's your read on the next 3, 6, 12 months?
I'm seeing that interest rates will continue to rise, of course, to continue fighting off this inflation. And asset prices will continue to be repriced, which we're already seeing. And hence why I say that the market hasn't bottomed, because ultimately in the end, as interest rates and yields go up, there's now technically another home for money. Because what we've seen is why asset prices, property, especially farmland, stock prices have run up over the last few years, is because interest rates were literally at zero. So nobody's been happy enough to leave their money and lock it in a term deposit earning less than 0.5% type thing. So money needed to find a home. So they found home in riskier assets. But now, because of interest rate rises, money's now getting pulled from these risky assets, stocks, property, farmland, and slowly going back into the cash side to earn at least a decent return. It's going to be nowhere near as high as that, but at least there is now a home for that, a home for the money, at least earning a decent yield. And by doing so, it's pulling down all the rest of the other asset prices. So I'm just seeing an opportunity to not be fearful about that, and actually, in fact, utilize this period to, like I said, to build up that foundation and start picking up cheap assets on the go.
So Terry, 6 months ago, we talked about COVID and the impact that had on global economies and how governments were likely to or needing to recover. What's your comment on that? And that stimulus and extra spending that we've all observed countries having to endure in order to get through the pandemic. What does that mean, and what extra risks are at play, and where might that see us arrive to locally and globally economically?
Yeah, great question, Jeremy. With the COVID, what I saw was, I think they went on for in terms of stimulus wise, they did too much and for too long. So as we're aware, they saved the global economy, but it was a certain stage which they probably should have stopped, but they kept on going. And now what ended up happening was, with all these literally zero low interest rates for way too long, it created an extra amount of, I call it debt creation, from both individuals and also from companies. individual wise, a lot of people, I think I'll even say a lot of the millennials, which have never seen high interest rates in their lifetime. Whereas with us, like for example, we've seen the higher interest rates back in the 80s, and because they haven't seen it for they've actually never seen it in their life. A lot of them have actually overspent and only seen the good times, for example. And yet on the company side, a lot of them have borrowed quite a fair bit of money at literally very low rates and almost zero rates, and to expand as well. But now the companies that are going to be in trouble will be the ones who have way too much debt, because as interest rates start rising, they'll financially be quite stretched as well. So COVID had definitely had something to do with it, because that was the catalyst that drove down all the interest rates to almost basically zero across the globe.
So no doubt then that overspending means that the reality that we now look into going forward is different to that perhaps globally that it's ever been. What extra risks come with that? I think you mentioned prior to me hitting record sort of 4 key risks that you see now as a result of that overspending now as we recover.
Yeah, I think as we recover to, besides just the low interest rates, which is now going up to higher interest rates, the other issues that I'm also seeing that isn't really talked about is I call it a rising great power, which is China, of course, and we've been already covered that as well. And it's really challenging the existing world order. So, I mean, when I look back at the stats, right, back in the mid 1950s, after World War II, literally, the United States had 80% of the world's gold reserves, and it was literally 50% of the global economy. So their GDP was literally 50%. That's how big the United States was post World War II. And also that gave them the funding to create the military power that they have today as well. And we are literally seeing it shift and seeing China do the same thing now, because now, as we're aware, over the last couple of decades, they've now become, basically one of the world's great powers as well. And with all that funding, they're also doing the same thing and spending that on the military side as well. And hence why they've been, in this position to potentially even threaten Taiwan, which we've been talking about. So that's one of the other risks that I see. The other risk I probably see is we hear from on the news constantly as well, is the rise of just the number of natural disasters from climate change as well. And I know a lot of people talk about, potentially saying, this is climate change is baloney, it's not happening, etc. But just the amount of droughts, floods, hurricanes that we're seeing, just these extreme weather pattern changes over the past, just this decade alone, I think it's a cause for concern. So hence why ourselves, which we used to be quite invested in insurance companies, but we've actually, myself included, I've actually avoided a lot of insurance companies, because you just don't know when you buy these insurance companies where a left field event could happen and wipe out their multi-years of profits as well. So that's one of the other risks. And I think it's just the final risk I'll probably see is, which isn't really talked about, is that widening wealth gap. Because as countries become more and more wealthier, so to speak, they produce more, but at the same time, we also consume more. And it just feeds back almost like a loop back to climate change. As we consume more, we need to produce more, and these factories are just pumping out goods as well to satisfy that demand as well. So I think it's just this revolving cycle overall.
So the R word.
Yes. The big recession.
Yeah. What do you reckon?
I think the global governments and central banks have a bit of work on their hand, where they're trying to balance that balancing act of increasing interest rates to fight off inflation, but yet not accidentally tip their own economies, plus potentially the world global economies, into a recession as well. Personally, I think it's a very hard job. I don't think it can be done. I reckon that we will have one. I don't think it will be short, it will be a long-lived one. It might be a short one, because ultimately then the big R word scares a lot of people. But what does that actually mean though? All it means is just that any economy has 2 negative GDP quarters, and that's it. But it doesn't mean anything else really, because in the end, the question that needs to be asked is, are the companies laying off staff and there's high unemployment? Is there extremely high interest rates, which companies can no longer afford? They need, of course, now to cut back costs, which includes employment as well and staff. We are not seeing that. Hence why I say that even if we do go into the big R word, I don't think, just from the stats, I don't think it will be a long-lived one. I think it will just be a very short one, and we'll get out of it as well.
It's so interesting, Terry. So what would your advice be on what investors should be doing? What actions can they take given that landscape and that, we're not yet at that dip or the bottom? If just to take your commentary, what are the opportunities and what actions would you suggest investors take?
I think this over this time period right now, in the volatile period, I think it's all about risk minimization more than ever. So it's important to firstly have quite a bigger picture look and be diversified as well as balanced as well. So that's one. But the other thing too is to focus on quality companies, basically. So companies that we are happy to own for a long time, but also ones we can sleep well at night as well while we own them. And most importantly, though, is the valuation, to not overpay for it. Ensure that we understand how much is that stock actually worth, and pay no more than fair value, or if we can, pay undervalue. So I always say, a simple analogy is like most investors, what they do is they end up, say, buying I use like cars as an example. They buy a Kia, which is a good car, but the problem is they pay a Mercedes price or a Ferrari price for it because they had no idea what Kia was actually worth. What we want to do is we actually want to buy a Mercedes or a Lexus, but pay a Toyota price for it. And if you do that enough times, you're underpaying for the company that you own. So you've bought it at a great price, but also you're buying at a good dividend yield, which will pay you and provide you that passive income for life as well.
It just speaks to the importance of learning how first, doesn't it? Like, in order to value a stock, be it a farm or an accounting firm or a local business or a global stock, you've got to know how to value it so that you can determine whether there is value within it. And I guess that speaks nicely. 2 or 3 times a year, everyone, we ask Terry to put on a webinar exclusively for our listeners and our community. And in that, Terry goes into quite a bit of depth about teaching about how to value stocks and how to identify a good opportunity and then how to take action on that. As you've heard me say in previous podcasts, we just value Terry's expertise in this space, the way in which he teaches, and the support then that he offers to our members who are keen to take control of their wealth creation. So that webinar that we're running just for you is on Wednesday, the 24th of August, and it will be in the evening from 7:30 until about 9:30 Australian Eastern Standard Time. So mark that out in your diaries, Wednesday, the 24th of August, 7:30 to 9:30. And in that, again, Terry will speak to what he's seeing at the moment, perhaps in a bit more detail, but then show you how to make the most of the opportunities, analyse stocks well, and get a first glimpse of how to really take control of wealth creation for you and for your family. Terry, what is that webinar about? And would you mind just speaking to what you'll cover over that 2-hour session on the 24th of August?
Yeah, sure. So I always firstly start off with allowing and teaching people how to actually firstly understand the world, which is what we've been talking about. Because funny enough, there actually are tools out there and they're free too, by the way, free tools out there, which allows a person to physically actually see in advance, weeks and even months in advance, of a potential market correction or market crash. So all the things we've seen and heard about from the news, for example, from the coronavirus, all the way to the Russian-Ukraine crisis as well, that, funny enough, was already channeled through the markets. And you can see that, not the exact day, but about 1 to 2 months prior to that. So we were seeing that way before that. And hence why when coronavirus happened back in March of 2020, we were in position, we started selling down our portfolios back in December of 2019. So we were selling down and prepared for that whole crash. And we actually got excited about the market downturn. And a little bit upset because the government stepped in with a stimulus and stopped the downturn. So it only, I say the word only, went down by about 35%. But without that stimulus, the markets would have had a GFC number 2, global financial crisis 2. So that's one of those things what I'll be teaching, but also teaching also a number of tools which what we've been talking about. How do you actually focus on quality, and what are those criteria to choose the quality company? So literally within a minute, when someone gives you a tip or you get an idea, you can literally under 60 seconds know whether that's actually even worthwhile looking into from any company that you look globally, not just Australian, but also globally across all markets. So those criteria will be taught during that masterclass. So it's going to give you a very good glimpse. And even if you've got a financial planner, once you learn that, in actual fact, I always say this loosely, challenge the financial planner and ask them, because you'll find out you'll probably even know more just from that masterclass alone.
Guys, I have sat in on a few of these now, and I'm halfway through Terry's masterclass on this, and I'm getting so much value and getting so much more clarity on the direction that we're taking with our off-farm investments. And so, get involved and join us on the 24th. And it's a cracking session. On a lighter note, Terry, you got to enjoy a holiday and tick off a fairly significant bucket list item. At the end of the day, all of this wealth creation is just to help people live their best life.
Yes.
Can you just share with us your highlight in Exmouth in WA that was one of your bucket list items, and how that experience was?
Awesome. Yeah, definitely. Because I've always wanted to, I've always liked wildlife, and especially marine life. And on my bucket list for years, and my wife's bucket list has always been to literally swim with whale sharks and just see these magnificent big beasts in the wild doing their thing, and being able to, one, get close to them, and even possibly, hopefully, not just to see them, but actually experience swimming next to them as well. So luckily we had awesome weather. We spent a week and a half, 2 weeks there, and we just had multiple dives day after day. And the great thing too was that every day all the whale sharks came out to play. So they were feeding, and we would go into the water, and within 30, literally at a minute, they'd come by, and with our flippers, we'll just swim alongside them as much as we could, because surprisingly, even though they look slow, they're actually quite fast. So you're just, and you'll be spent by the end of that little swim. Then you jump back on the boat, and then you just have a bit of a hot chocolate, and then gather your energy again, and then go for another dive again. So we just had multiple dives for the entire day. And day after day, we did that for a whole week. And then before we left, we also thought, okay, why not charter a little plane to go up in the air and actually be part of the experience of spotting them? Because the reason why we've got such a high probability of seeing them in the water is because the spotter planes in the air. So they help locate where they are, and then the boat just literally goes to that location, and that they see their direction, and we just jump in the water and we see them and we swim with them. So I thought I experienced a spotter plane as well. So I jumped onto one of the spotter planes and spent about 2 hours in the plane with my wife and as a co-pilot, and literally flew around, and we just saw them from the air as well. And sometimes we'll zoom in quite close from the air and swoop down and literally observe them from the air. And besides that, we saw a minke whale, plus pods of a ton of sea turtles. And also we had a chance to also swim with the manta rays while there as well, a school of them, which was incredible.
Unbelievable. Terry, thank you.
No worries.
I'll add that to my bucket list.
Definitely do it when you get a chance.
Terry, as always, really appreciate your time and just getting that really accurate view of the global economic climate, but equity market, and your tips and advice on how to navigate it. It's always great to have you part of Profitable Farmer, and thank you again for making time available on the 24th of August for that exclusive webinar for our listeners and for our community.
No worries. Yeah, thank you, Jeremy. Always for a pleasure to be on live on these podcasts and share my message and being able to teach as many farmers as possible as well. Create that wealth outside their farm.
Perfect, Terry. Thank you. So I hope in some way that's helped all of you, no matter where you're at on your wealth creation journey, be clear on where we are at the current moment and how to take some meaningful action to improve your situation given the climate that we're in. Thanks, everyone. I hope that's been helpful, and take care, and we'll look forward to connecting again in a couple of weeks' time. Bye for now. Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long time listener, let your friends know about us or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.